Welcome back to The Explainer. Today, we're doing a reality check on Freeport-McMoRan, ticker symbol FCX. We are going to test the incredible market hype surrounding this stock against the company's actual underlying financial fundamentals. We're pulling data directly from the source to see if the economic engine running this massive company actually justifies its soaring price tag. Okay, let's dive right into this. 523.86%. Honestly, just let that number sink in for a second. That is Freeport-McMoRan's staggering 10-year return. If you had parked your money in FCX a decade ago, you'd be looking at an absolutely massive gain right now. That metric alone builds this incredible aura of awe around the stock, right? It establishes FCX as an absolute powerhouse when it comes to historical market performance. It's exactly the kind of long-term return that makes every investor sit up and pay attention.
But here's the thing. This explosive momentum isn't just ancient history. It is happening right now. The stock is up nearly 25% year-to-date and an incredible 65.69% in the trailing 12 months alone. This absolute tear in the market has pushed Freeport-McMoRan's market cap to nearly $91 billion. It's a massive, surging giant in the market today, and the sentiment is clearly undeniably bullish. But, we can't just look at a stock chart. We have to look under the hood at the underlying value.
And cue the record scratch. Look at this disconnect. We have a soaring market price closing recently at $63, but sitting right next to it is a calculated fair value price of just $21.65. Now, this fair value calculation isn't just pulled out of thin air. It's derived directly from the company's discounted cash flows and earnings per share. This is a massive gap. The market is pricing the stock like a high-flying rocket, but the foundational math suggests a deeply discounted fair value. When we actually calculate the difference between that soaring $63 price tag and the $21 fair value, we arrive at this number, negative 190.98%. That is the exact negative margin of safety. What this means in plain terms is that right now, buyers are effectively paying a massive premium for the company's current cash-generating fundamentals. There is essentially zero margin for error baked into this valuation. None.
And this brilliantly illustrates exactly what we mean when we say premium. Across the board, buyers are paying a steep price compared to the stock's own 5-year historical averages. The price-to-earnings ratio is sitting at nearly 42, which is over 36% higher than its 5-year norm. Price-to-sales, up over 31%. Price-to-book is up 21%, and the price-to-free cash flow ratio is hovering at an astronomical 56. Basically, every single metric on this table screams that the stock is historically stretched.
Section 2. The Engine Room, Revenue and Cash Flow.
When we looked at the trailing 12 months, the stock price has literally exploded upwards by 73%. But the revenue growth, it's sitting at a tepid 1.81%. This perfectly visualizes the disconnect we're talking about. The price growth is completely outrunning the top-line fundamentals. The business's revenue is practically flat in the short term, while the stock is priced for absolute hyper-growth.
Now let's be fair and acknowledge the scale here. The company is still an absolute behemoth of a cash generator. They pulled in over $1.6 billion in trailing 12-month free cash flow. That's real, tangible cash left over after operating expenses and capital expenditures. You don't get to a $90 billion market cap without throwing off serious cash, and to be clear, Freeport-McMoRan certainly does that.
Now, what's really interesting about this slide is the actual direction that cash flow is heading. Yes, $1.6 billion is a lot of money, but look at the growth trajectory. Over a 3-year period, free cash flow growth is actually negative 3.81%, but over the trailing 12 months, it has contracted sharply, down nearly 40.5%. This is an alarming negative trajectory. So while the stock price is soaring into the clouds, the actual free cash flow being generated is shrinking significantly. We see a really fascinating contradiction when we look at earnings per share too. The short-term trailing 12-month EPS growth looks fantastic, up over 48%. But zoom out to look at the 5-year span. Actually, scratch that short-term optimism, because the compound annual growth rate for EPS over 5 years is negative 10%. So we've got an impressive short-term pop in earnings that's essentially masking a concerning long-term contraction. This kind of underlying volatility makes that $63 stock price look even more precarious.
Section 3. The Safety Net, Debt and Health.
0.50. That is Freeport-McMoRan's debt-to-equity ratio. In the world of massive, heavily capital-intensive mining and resource companies, this is an incredibly healthy figure. In fact, the data shows this is 22% lower than their own 5-year average. So while the valuation multiples are stretched incredibly high, their leverage is actively being managed down. They're actually operating on a very solid foundation.
And from a foundational standpoint, FCX has incredibly strong liquidity. Their current ratio sits at a robust 2.29, meaning they have more than twice the current assets needed to cover their short-term liabilities. Even their quick ratio, which entirely strips out inventory, is over 1. They can easily cover their short-term obligations without breaking a sweat.
That financial strength translates nicely to their dividend strategy. Now, the actual dividend yield is quite small, just 0.95%. But look at the underlying payout ratio. They are only paying out about 40% of their earnings to cover that dividend. This ensures the dividend is highly safe and sustainable, and more importantly, it leaves roughly 60% of their earnings retained right inside the business to reinvest or pad that already healthy balance sheet.
So the crucial point is this. We have to weigh 4 distinct realities that this data has revealed. Step 1. We have an exploding stock price that has brought incredible historical returns. Step 2, that price explosion has resulted in stretched valuation multiples that are trading at massive premiums to their 5-year averages. Step 3, under the hood, revenue growth is flat and free cash flow is actually contracting. But, Step 4, the company operates on a highly secure, well-managed balance sheet with low debt.
Which brings us to the ultimate takeaway for this explainer. I want to leave you with this provocative question to chew on. Do the underlying financials justify the premium price tag? You've seen the booming market sentiment, but you've also seen the contracting cash flows and the negative margin of safety. It's up to you to decide if the story of the market outpaces the reality of the math. Thanks so much for joining me to unpack this data, and remember, always keep questioning the numbers.